Next up, we are diving into a fascinating and frankly cautionary tale. We're going to dissect the failure of Silicon Valley Bank SVB from about 10 years ago and play if with an investment scenario. I mean, it was the bank for startups, right? Everyone who was anyone in tech had deposits there. And then, poof, gone. It's a great case study on risk management, rather, the lack thereof. Now, imagine you were savvy enough back in, say, 2014 to see something special in SVB. What could that investment have looked like today?
Wow, 2014. That feels like ages ago. I was still figuring out what a stock even was then. So, SVB failed recently, right? Like within the last year or so, but it was around for decades before that. It's kind of hard to wrap my head around how Asbank just disappears.
Exactly. It's a stunning story. And yes, March of 2023 marked its downfall, but it had been steadily growing since 1983, built on the back of tech boom. Let's rewind to 2014. SVB stock, trading under the symbol SIVB, was hovering around 65 out share in January. It wasn't exactly screaming me, but it was consistently profitable and uniquely positioned. Now, if you had put, say, 10-0 into SVB on January 2014, that's about 154 shares. Let's see where it would be today, theoretically.
Okay, 10-0 in 2014. Sounds doable. But just to clarify, even though if it was doing well, wasn't there something inherently risky about being so focused on startups? Like putting all your eggs in one basket?
Brilliant question. That's exactly where the story gets interesting. They absolutely were concentrated. They boasted about serving over half of you. As startups, at the time, it was seen as arc strength. They understood that market had relationships with venture capital firms, but it was a massive concentration risk. Now, fast forward. SVB's stock peaked in November 2021 at around 750 L share. So those 154 shares, that's over 115 zero. Not bad for acting your hold.
Oh, 115 0 from 10 0. Okay, that's significant. I mean, it sounds amazing, but knowing how it ended makes me nervous. So what happened? Did that bubble burst again? Because didn't we have one in the early 2002?
You're spot on about bust. In the early 2000s, SVB actually survived that. Though it took a thing. But this was different. It wasn't so much the tech sector failing as it was a perfect storm of rising interest rates and poor asset liability management. They had loaded up on long-term treasury bonds, thinking they were safe. When the Federal Reserve started hiking rates to combat inflation, those bond prices plummeted.
Okay, I think I'm starting to get it. Bonds going down in value when interest rates go up. That's like basic economics, right? But how does that crash Asbank?
It's the mismatch between assets and liabilities. SVB had these long-term bonds with declining values. At the same time, their customers, those startups flush with venture capital funding, were withdrawing cash to fund operations because they were burning through money, as they call it, needing funds for payroll and development. To meet those withdrawals, SVB would have had to sell those devalued bonds at a plus, and that triggered panic.
Oh, so they couldn't access the value of their assets quickly enough. Like trying to sell your house in an emergency when nobody's buying. That makes sense.
Exactly. It sparked a classic bank run, fueled by social media and the fact that most of their depositors had far more than the 250 zero FDIC insurance limit. People panicked and pulled their money out in mass. By March 2023, SVB was seized by regulators. Those shares that we're worth over 115, zero, worthless, poof, gone, a total loss.
That's brutal. So even though they had a good strategy for years and years, it all fell apart because of interest rates and a little bit of panic. It's a really scary lesson in risk management, isn't it? I mean, the article mentioned they didn't have active risk officer for a while.
Absolutely, a critical oversight. They had a risk framework on paper, but lacked someone at the helm to truly assess and manage those risks effectively. And that concentration in startups, what was an advantage, became their undoing because everyone ran for the exits at once. It's a reminder, even if you understand your customer perfectly, diversification is crucial. I remember back in the early 90s when long-term capital management, this hedge fund full of Nobel laureates, collapsed due to similar miscalculations about risk. It was as wake-up call then, and SVB should have been a wake-up call now. It's like my grandfather used to say, as broken clock is right twice as day. But you wouldn't build your life around it.
That's great advice from your grandfather. And this whole situation feels relevant right now with everything going on in the economy. It just shows you can do everything for decades and still be wiped out by something unexpected. I think I'll stick to index funds for a while. Maybe avoid banks whose entire business model revolves around poker games and wine.
A wise decision, my friend. A very wise decision. And that's the story of SVB, a cautionary tale wrapped in a fascinating history. It really highlights that even with all the data in the world, understanding risk appetite and capacity is paramount.